Hey guys, it's Bill Lewis with Choice One Mortgage. I want to put a video together that answers a very common question that we receive from new home buyers. They're always asking, what is the difference between an FHA loan and a conventional loan? And what type of loan should I use to purchase the new home? So I just wanted to give you a couple of examples and scenarios so that you could see the difference, or a typical scenario to show you the difference in each. So let's just use a purchase price of $350,000, and this borrower has a 640 credit score, which is a relatively low credit score these days. But I'm using that for a reason. So let me show you this scenario first. An FHA loan allows you to put as little as 3.5% down. That's one of the great benefits of doing an FHA loan. So on a $350,000 purchase price, your down payment would be $12,250. The FHA program also requires that you pay what's called upfront mortgage insurance, or an upfront mortgage insurance premium of 1.75%. They do allow you, however, to add that to the loan amount or to finance it, so you do not have to come out of pocket and pay that as a closing cost. Most of the borrowers that I've worked with over the years, I've been doing this for over 20 years, have financed the upfront mortgage insurance premium. Very, very few choose to pay it out of pocket. So your new loan amount becomes the base loan amount plus the mortgage insurance premium. Look at the interest rate on a 640 credit score. FHA's rates are very, very low right now. Even with a credit score of 640, you can get an interest rate these days of 3.625%. FHA allows us to go as low as a 550 credit score. Rates are higher the lower the credit score goes, but it is one program that allows lower credit scores these days. So based on this loan amount and an interest rate of 3.625%, there's your monthly mortgage principal and interest payment. Here are the property taxes split out by month. Here's the homeowner's insurance premium based on a $350,000 purchase price. $80 a month might be a little high, but let's use that just for this estimate. And then the monthly mortgage insurance premium that FHA charges is 0.85%, which comes out to $239 a month. So your total household expense, when you add up these numbers, is $2,251 a month. In the California market, homes that sell in this price range often have monthly rental charges that are about this much. So a lot of renters are trying to get into homes with as little money down as possible, to take advantage of being a homeowner. The real rate of interest on a FHA loan, when you add the actual interest rate with the monthly mortgage insurance premium, comes to 4.475. So that's an FHA scenario. Let's look at the same scenario on a conventional or Fannie Mae loan. Fannie Mae loans typically require a larger down payment. Often it's the lowest you're going to get is 5%. So let's use that here. So your out of pocket is higher on a Fannie Mae or a conventional loan. However, you don't have that upfront mortgage insurance premium, so the new loan amount is lower. You're financing less. But look at the interest rates. The interest rate on a conventional loan with a relatively low credit score is 4.999% today. That's quite a bit higher than the FHA equivalent. So of course your monthly payment's going to be higher. The mortgage insurance premium is also higher with these lower credit scores on a conventional loan. So at the end of the day, the total monthly household expense is considerably lower on an FHA loan. You would save $269 a month by going FHA. And look at the real rate of interest. The difference is over 1.5%. So FHA for borrowers with relatively low credit scores is really the best way to go. Sometimes it's the only way to go. Conventional loans typically typically have a minimum credit score requirement of 640 anyway. So if you do have a lower score than 640, FHA may be the only way to go. And just so you can see the benefit, look at the difference. The annual payment savings is over $3,000 a month, and your out-of-pocket or down payment savings is over $5,000 a month on an FHA loan. So if you needed the money for furniture or other things to fix up your new house, FHA is also beneficial. So let's look at another scenario where we have a higher credit score. Most people with a 740 credit score would never even think about doing an FHA loan, but there are certain scenarios where it still makes a lot of sense. So the interest rates are again super low. They're just much lower than conventional loans. These rates are coming down on Fannie Mae 30-year fixeds right now, but these are no point rates, and FHA is still quite a bit lower. The difference, though, is you have that higher loan amount due to the upfront mortgage insurance premium, and now the mortgage insurance, monthly mortgage insurance premium is higher on FHA. It's only 0.35% for a borrower with a 740 FICO. So the base rate plus the mortgage insurance on an FHA still gets you a lower all-in real rate, if you will. But because the loan amount is quite a bit higher on an FHA loan, the payments come out to be roughly the same. So why would somebody do a FHA versus a conventional loan with a really high FICO score? It usually comes down to down payment. If you just don't have the money to come up with a 5% down, or you prefer to come out of pocket less to preserve that money for savings or for furniture and other things to fix up your new home, FHA still makes a lot of sense. There are other differences that are important to discuss, and we go through all of that with you. So, feel free to call us. Again, it's Bill Lewis at Choice One Mortgage. My number is 800-224-9999. You can also find us online at www.choiceonemortgage.com.